Morning. Good morning, everybody, and welcome to Tapping Oil. The discussion has begun, and I dismiss that. So we're looking at, you can say my trade currently, and I want to unlock. Okay, that's what I want to do. Unlock that one. So with current, this is CL's price. What B8? So that's the current options and where they're at. The current price is 66.24. So, like I say, this is you were muted default wise. I activated your mic for you, Andrew. So no sweat on that. And as Mark was talking about some stuff that's going on the forum, or looking at stuff.
Yeah, I was saying that there are four tenets or four basic pieces, and then you can add on to that all commodities ought to be concerned with. And one of them's technicals, one of them's fundamentals, and you throw in news along with it. And one of them's seasonality, and one of them's commitment of traders. And so I'm not sure how much we know about commitment of traders, and we can only do a little bit of analysis on seasonality because they do have that that seasonality chart in the chart area. But if anybody wants to bring up, and I'm talking about anybody, that could be anybody that's listening or anybody that's listening to the recording, can bring up new things about technicals that they like or things that have worked for them. Or if they talk about news, they know something or they think something's going to have a bigger influence than something else, like let's say the Iran deal. I think it's interesting that the intended consequences may be completely different from the intended consequences, because they were supposed to stop Iranian oil, and it looks like that's not going to happen. We may get most of the countries to stop taking Iranian oil, but then China and India may take their oil for a discount, which means they're not buying oil for somewhere else, which means everybody has to lower their oil price. So telling Iran that they can't sell oil might actually lower the price for everybody in the world. It's a weird consequence. So that's kind of news reporting that we can look at, as opposed to new batteries coming online or regulations or choke points and pipelines from the Permian Basin, stuff like that. But also the fundamentals about the end of summer. If any of these regulations, or like the Iranian deal is not supposed to happen until November, how's that going to affect the Z8 instead of the V8, or the whatever, the U8, whichever contract's selling. So we look at the structure of the different contracts and see which ones your options are playing against. And so that's some of the news and the fundamentals and the seasonality. And I don't know much about commitment of traders. I know that I suspect, or I think I've heard, that 90% of all contracts are done by speculators, including you and me, but also including Goldman Sachs and Morgan Stanley. But then the other people are buyers and users and sellers, so people that have oil and people that need oil. So we'll try to figure out how much that influences the price of oil. But also the dollar being strong is keeping the price of oil artificially lower than it would be. How much? I don't know if it's $10 or if it's 10 cents, but there's some influence of the rest of the people buy oil in dollars, and if our dollar is strong versus theirs, then they're actually buying it for less and less money. So it'd be if it was the same number of euros, it would be fewer dollars. Anyway, that's my rundown of different things that we could have for topics if anybody wants to bring up something that they know about.
Yeah. So.
Yeah. And then finally, we can also get into different types of trades. And there's probably 6 different strategies we've talked about. I also mentioned a couple weeks ago that I thought the other Rick's strategy was reverse gamma scalping, and now I don't think it is. I don't know what to call it, because gamma scalping is one way and reverse gamma scalping is another, and I think it kind of is somewhere in between the two.
It does require a lot of work.
Yeah, all those you might be forced to make a trade 4 times a day. So it's not like watching paint dry. It's more like pulling your hair out. I was on a webinar last night and Tuesday night where I was looking at risk reversal strategies, and those look pretty interesting. And I think they're using it against stocks and against the stock market. And I think that risk reversal strategy has a characteristic that would be more useful against oil. And I think he said he used it on oil, but anything that has a relative range, the stock market just keeps going up, and it'll be 10,000. I'm sorry, the SPX will be 3,000 and then 5,000, just keeps going up. Whereas oil was going to stay somewhere in a relative range for a period of time. And a lot of these strategies happen in less than a month. So within the next month, it's probably going to be $5 up and $5 down. And so that's different strategies. The risk reversal strategy doesn't. You can get into it for $0 and have a relative range that has no profit or loss, but your deltas go up or down, whichever direction you're picking. And if it goes up more than your range, if it goes up or down more than your range, you either make or lose money. But in the meantime, you can offset or add to your deltas one way or the other. But it's pretty neat because he was doing some risk reversals one direction, and then to close them off, you don't close that position. You move over a strike or two and make either a butterfly or condor out of it. And you end up making all these little tents all over the place, and eventually you might build them into a structure that's $5 high all the way across. And so you have say you would be long an iron condor with a $5 roof on it. And that was interesting, where across a $5 or $10 oil range, you would be inside that tent and make a maximum of $5. You would have to go a long way to get outside your tent.
Okay, is that Rick's deal or what?
No, that was this guy is from Stratagem Trading. Yeah, Rick's deal had a deal where he was selling straddles, and then a reverse gamma scalping deal is very much like what we do. It has a little different trading advice, but if you had an iron condor and the market ran up or ran down close to one of your strikes, and you were getting close to being in trouble, one way of doing that we don't usually discuss is to buy or sell a future to offset your deltas. So you could say, well, if it's running up against your calls, you could buy enough futures to make your delta 0, and you still keep your theta, your negative theta. So you're making money on theta, but you don't have to worry about it running past your calls. Well, that would be reverse gamma scalping. And if you just put your iron condor into an iron butterfly, that's what reverse gamma scalping is. You basically try to collect as much money as you can, and then try to keep as much as you can, even though you have to buy or sell the underlying to keep your deltas at zero, and you assume you're going to lose money when it reverses. But I think Rick's strategy, he actually did the opposite. Whenever it went down, in this strategy, whenever it went down, you would sell. So you'd be selling into the momentum of the market, and he would be contrarian. And so I would call it doubling down. So if you were selling a straddle and the market went down, you would buy, which would increase your negative deltas. And if the market went up, he would sell, which would increase his, going down would increase his positive delta, and then going up, if you were high in the market, on the high end of the market, you would sell, so that would increase your negative delta. And so he's assuming that it will return to somewhere in the middle. And of course, that's why I call it doubling down, because you're already 100 negative deltas, and then you sell some more, so now you're 200 negative deltas. I think we've done something like that when we did, say, broken wing butterflies, or reverse, 2-to-1 ratios. If it went down, if you moved your strikes out, you would actually be doubling down. You wouldn't be completely doubling your deltas, but you would be increasing your deltas. So if you would have to move your calls up a few strikes and did a ratio spread, you would have to sell twice as many calls, but they'd be further away from the market. So you might have 1.5 times as many negative deltas as you did before the adjustment. Trying to keep all these different strategies and techniques in perspective to see how close they are, because eventually all we're doing is buying and selling a put or call or the future.
Yeah. Go ahead.
There was another strategy I was looking at on Tuesday on a different one. This was SMB. And they put out a strategy of an iron condor, and they wanted a no-touch trade. Well, I don't know that there is such a thing, but if you get a no-touch trade, you're going to go right with the statistics of how many times you win or lose, right? You can win with money management or by putting in tranches. But anyway, they were trying to come up with no-touch trade. So I didn't think the presenters were all that sophisticated, but they were presenting an iron condor and then buying an iron condor inside of it. So effectively what you ended up with was a ratio butterfly to the downside and a ratio butterfly to the upside in a ratio of 1.65 on both sides. It's like, and in the stock market, I think that's a really bad idea. They were doing against individual stocks, which might have a flat skew, but against the stock market has a very negative skew. It didn't work very well, but against the SPX. But against oil or something that has a flatter skew, that might actually work. So it's basically just taking the same iron condor that you have and then buying an iron condor inside of it. And then because the middle area was so low, they bought a butterfly or a double butterfly to raise the tent. And I thought that was a little overkill or a little too much for what they needed, because it just needed to get out a few days earlier. And the line, the profit loss line on say 10 days before expiration is way above the expiration line. So just don't wait for expiration. Anyway, it looks like a Hello Kitty or Batman type deal with two different bat ears on each side.
Okay.
So that was the same kind of deal that Optionetics taught, like 80s or 90s. Whenever I went to their class, Optionetics was teaching that, and then a Random Walk and the others were teaching the same kind of strategies.
I think that was in the 2000s, but that's.
Oh. Yeah, there's Richard. Richard, I was discussing that strategy on that video I sent you that had the iron condor you're selling iron condor on the outside and then buying an iron condor on the inside. So it looked like a 1:6:5 ratio butterfly on the upside and in the same ratio spread to the downside. And I think that's more effective strategy in oil or some other commodity or some other market that has a flat skew. I didn't think it worked very well in SPX because of the negative skew. And
okay, I haven't had a chance to view that
Okay.
yet. I've had some out-of-town guests in, and it's been
Well, it sounds like a good thing.
it probably is. Pries me away from my computer.
Anyway, those kind of when they were talking about that Optionetics deal, they were teaching a similar kind of strategy. Do an iron condor, and then if the market moves towards one of your sides, then put on that that debit spread to protect your position. And of course, that guy last night was talking about the same kind of deals. If you had a side that was getting threatened by a debit spread on the inside to protect the short. So you might buy if you had like in this case, you had a 15 point wide leg on the downside and it was getting threatened, you might buy a 5-point wide leg on the upside, on the inside to protect it, and at a ratio of 1:5 or 1:4 or 1:10. So it just kind of flattens your delta on the way up, and it has to go through your profit zone before it gets to your shorts. Those are different type of strategies that I picked up this week. And I don't know, I'm kind of scatter shooting to see if any of them work for me, and I'm kind of interested in those risk reversals.
So what do you mean when you say putting on an inside spread? You mean?
Well, we're selling iron condors, and if you bought an iron condor, then it would look exactly the opposite. And then if you move the strikes in where you're still selling the same point, in other words, when you're selling an iron condor, you're selling the inside strikes and you're buying the outside strikes, just like he's got on the screen. And then if you were to reverse that and move the strikes in, you'd be buying the inside strikes closer, say $1.1 closer to the money on both sides. And then the strikes you'd be selling would be the same points that you were selling on the original iron condor.
Okay.
So let's say so it looks like a ratio spread. You buy one that was $3 out, you'd sell 6 that were $4 out, and you'd buy 5 that were $5 out. 3, 4, 5, anyway, 3, 4, 5. And that's not what you should do. That's just an example. So if you went out $3, you'd be long 1, and then you went out $4, you'd be short 6, and you'd go out $5, and you'd be long 5. So it'd still be butterflies. That would just be a ratio butterfly.
Okay.
And since all these things are like a box, you can look at it one way or the other. You can look at them as 2 ratio butterflies, or a short iron condor on the outside and a long iron condor on the inside. Mm-hmm. They both describe the same box.
So of those that you saw, were there any that you liked the best?
Well, the best, yeah. I'm trying to put together a hodgepodge of strategies that, because obviously the highest profit potential is just selling naked straddles, and I'm just too chicken to do that. The next closest is selling naked straddles, and I'm doing some of that. But for a set it and forget it, or look at it every day or two, their strategy last night or Tuesday about what I would call a bad ear, or my girlfriend called it Hello Kitty, where you have this ratio butterfly on both sides is fairly forgiving. It has, if you bought the iron on the inside, you're giving up too much money. And Richard, I remember a couple of weeks back, we looked at your strategy and you had those ears on one or both sides, right? So you're actually familiar with what we're doing. You just may not be able to pick it up from the way I'm describing it.
Okay.
When your expiration graph actually goes up on each end, it looks like it has little ears on both sides.
Yeah.
That's the kind of strategy we're looking at. And what you're doing is you're buying your insurance on the inside instead of buying it on the outside. So you're paying a lot of money for it. But every once in a while, it'll get right. If you take it to expiration, you'll get right up inside that point, and you end up making a killing, or anywhere close. Even if it gets close to your inside point, the profit and loss graph, if you do the 4-day step, profit and loss graph goes way above the expiration. Anyway, in their strategy, they actually bought a calendar in the middle of it, and then someone else suggested they do a double calendar. And I remember doing this 10 years ago, where I had these kind of strategies, and they don't really offset volatility like the way you think it would, because the closer in month grabs volatility faster than the out month. And in futures, it's probably not great to have calendars against it anyway, so we probably won't even talk about options calendars. You got it yet? $60, $70.
Oh, so
Try 40 there. Try 40 and see if that doesn't do what you want. Okay, look at that. Now you'll.
this is should be either flat across here or flat across there, if I get it right.
Oh, they're all puts. That's the problem. I thought you were doing put and calls.
Oh, okay. Okay, that's
Okay, are you selling the middle or are you selling the outside? Think of it as an iron condor right there. Buy, sell, sell, buy. So the number should run from the bottom to the top. So at the bottom, let's do 40, 50, 60, 70.
yeah. 40, 50.
60. This will be one of them. Turn it around to do the other one. Okay, if we got it yet? No.
It doesn't look like a condor to me, but
No. Why don't you do an iron condor? This should work though. I don't know why it's not working. Okay, let's keep them in relative range because they're already set up correctly, but they're just half a point across. Okay. Oh man, how did we get that wrong? Because the words on there look right, and the picture didn't look right.
So actually, this is going to be reversed.
Yeah, that's it. Okay, so that's your standard deal. Now, do a analyze opposite trade. Okay, let's move those points in a couple of dollars.
On the analyze?
Yeah, on the green one. Let's move the let's move the 70 back up to, I'm sorry, what are, yeah, let's
80?
move the 80 to is that the one we bought?
This is the opposite. Green's opposite.
Okay, you're right. So we're buying the 68. Let's go from the top to the bottom. Let's buy the 68 and then sell the 70. Okay, and now we're selling 60. Let's do the 60 becomes a 62. And then that's 60. Okay, now this is a broken wing. This is a broken wing butterfly because it's got the same scale.
Now uncheck your padlock there on the opposite. Okay. I guess it would be still be the same. Okay, I'm sorry. Yeah.
Okay. Yeah. See that on? That's the expiration graph. Now let's go to a 4-day step. No, you have to put it on 4+ days before you go to the step. Here we go. Okay, just keep going. Take that step of being how many days is that? 7. Let's take it up to about 10 or 15. One more. Let's keep going until that yellow line breaks. One more right there. Okay, let's go down to 17. Okay, now let's take today's date, move it forward to the 10th or 11th or 12th until those lines become the expiration graph. Right there. Okay, so now the yellow line is the expiration graph, but notice the white line is above the yellow line. So that means sell this thing before you start having negative theta if you're in the middle. And also notice that since we spent so much on that green on Condor, the ones we bought, that's insurance on the inside that we may not want. So let's take that 10 down to 5, the green one. Let's take that up to 20. Anyway, make it a 2-to-1 ratio. So another way of doing it is to make a ratio of if these were $10 wide. If we were to make the green one $10 wide, those would be ratio butterflies because they'd be the same size but different numbers. Before we had the same count but a 2-point wide, and now we've done both. We've changed the length of the leg and we changed the count. So a count makes it a ratio and the length makes it a broken. And we've done both here. We've got a broken ratio butterfly on each side. That's the kind of stuff they were talking about. So it still has, for the first 3 expirations, it still has the same frown curves and still has the same kind of delta gamma, but it's a lot flatter than a straight iron condor. If you uncheck the green one, you can see the difference in the, you get the same kind of curve, but it's a lot flatter. And it's a lot higher if you don't buy the insurance. And we found that out if you just do naked strangles, they make more money than buying an iron condor. And if you buy insurance, that's going to go to waste. You're going to make less profit. But it's flatter. You don't pull your hair out in the meantime. So it's just another variation on the theme.
Okay, so basically it looks like as I analyze this in your green band, you're selling the same strikes. Am I correct on that or close to it?
Yeah, why don't you take off the red and turn on the green so he can see a picture of the expiration graph on just the green. See, it's just the negative of an iron condor. I mean, you're buying an iron condor instead of selling an iron condor. It's like when
Okay.
you sold an iron condor to start with, you buy it to close it out. Well, what if you bought it twice? You'd end up with this kind of structure.
Bought
And
it twice. What do you mean bought it twice?
if you sold one and you bought it back, and then you put another order in there to do the same thing. So
Okay.
you,
Oh, I see. So in other words, that's the 10 versus the 5. Okay.
yeah.
Is that
Anyway,
what you
that's
mean? You're selling 10, buying 5, so you're left with 5.
yeah, and that makes it a ratio. Yeah, the 5 to 10 makes it a ratio because the number of contracts and the distance between the two points on the one you're buying and 10 points on the one you're selling, that would make it a broken wing butterfly because you're not using the same width of your strikes. And in our case, we're actually doing both. You know, the first time we did a broken wing butterfly, then we reduced it down to 5. If we made it if we made the green one a 10-point wide butterfly, then it would be a broken wing butterfly. Or I'm sorry, then it would be a ratio butterfly because it'd be 5 to 10 with the same width of the strikes. But anyway, since it's a box, in other words, since we're doing both the same thing on both sides, you can describe it as 2 iron condors, or you can set it up as 2 broken wing butterflies. And I guess in some machines, I don't know, I don't think Thinkorswim allows you to, but other places I've been allow you to do six legged spreads. And so you could put all this up into one spread because you only have 6 different points you're talking about. Each of those butterflies have 3. And so in some places you could have put that in as one order. Anyway, then becomes a judgment call. Do you need that iron condor? And when do you need it? So you could say, since that green iron condor has negative theta, why don't I just wait until one side gets threatened or the other side gets threatened and put on my debit spread then, or put on a broken wing butterfly at that time. Mm-hmm. So you could say, let's just wait until I need it. And if you never need it, you never have to buy the insurance. Or you could wait till it gets to till it gets a little close to one side or the other, and then you'll have to spend a little more for that insurance, but hopefully theta would be cutting down the cost, and you don't have to buy the other side. Mm-hmm. So that's the way it was taught at Optionetics.
Mm-hmm. Sounds interesting.
It is. It's not bad. And that's the video I sent you. But of course, they go through a lot of other crap before they get to it, and then they don't explain it very well, and they don't really know what they're talking about. But that's what they're talking about. But not saying this is the end all. This is just a variation on you're trying to sell an iron condor, and then you're trying to protect it one way or the other. When do you protect it? How much do you protect it? Which way do you protect it?
And so the idea is you protect it with half the number to make it.
No, I'm just using that as an example. So if the things are really big, let's take that down. Let's take the 10 down to 5, and let's take the 10 down to 6, and take the 5 down to 1. That's what they were talking about. So they were doing something like that. They may have, of course, they were talking about the SPX. So they were, they might have been doing something more like 5 points on the outside and then 5 points on the inside. They might have been doing the same deal. $65. Yeah, let's do 65 on both, so it becomes a butterfly at that point. It's an iron butterfly. Anyway, that's what you got to mess with: is what strikes, how how much insurance you want to buy, when you want to buy it, where you want to buy it. And so anyway, those lines become a lot flatter. There's more gamma when you deal with just an iron condor. Oh, yeah. Anyway, that's what I learned. So we can, if anybody gets interested in that, we can get into it more. That's just one way of doing stuff.
Basically,
Anyway,
you just have to pick a strategy that you like and learn to manipulate it.
Yep. So this is still based around an iron condor, and then it's how much insurance do I want, because the moneymaker is still the iron condor, and you're taking part of your profits to buy insurance. And there's different theories on how much insurance you want to buy, and other people don't buy any. They just rely on their moving away from the market if it gets closer. Other people buy futures to offset that. The kind of a reverse gamma scalping we talked about. There are at least a dozen strategies or variations on strategies we've talked about from different people. And they all can make money, but when you look at the numbers, they should all break even, except for slippage and commissions. So if you just left them alone, you'd probably end up with exactly enough winners and losers to break even at the end of the year.
Yeah.
But if you use a little bit of money management technique, like I know Chris says, well, if it gets up to 200%, he just takes it off. He just takes his 2%. He is 200% loss or 100% loss that month, and that pretty much wipes out 2 months worth of profits. But he has 10 other winners or 11 other winners that end up making a 10 months worth of profits out of a 12-month year. And it's like, that's good enough. You know, so anything like that, or even if you end up losing 2 months, you'd end up with 8 months of profit during the year. And that's a pretty good ratio. And of course, most of the time we talk about not going all the way to the yellow line. We talk about closing out around the green line or maybe even the yellow line. But that would be, you know, the white line there would be 17 days until expiration, and the green line would be 34 days until expiration. So somewhere around there saying, hey, we're getting too close. The gamma's getting too sharp. Let's get out and sell the next month. And I think that's kind of common. I think we've only had one person in here that took things to expiration. Of course, I've got some hedges that I'm taking to expiration. What, I've got 6 days left, 7 days left. So I've got a few puts that are in the money that are covering some of my longer dated positions. Let's see, what's the next one? 35 days, 40 days, something like that. The next expiration is maybe 42 days out. And I've gotten out of all my 42 DTE positions. So I keep buying some that are out further than that. I keep selling some that are out further than that. And then I buy insurance on the closer end ones.
How's that work for you?
Been doing great. Of course, I'm always buying the wrong thing, you know. If you ask my advice, just flip it around and do the other way. You'll be fine. But you know, oil was going up overnight, and I said, man, I better buy some more insurance, and I did. And within 5 minutes, it started going down and did not stop until it was down $2.50. I'm like, great, that's perfect.
Guys, can you hear me?
Yes.
Please.
Hi everyone. This is Andrew. Just had general question for you, and that is, I mean, I've been looking at CL for the last several weeks. I live on the West Coast near San Francisco, and what I've noticed is that oil moves sometimes during the night hours, sometimes on weekends, and sometimes these moves are really big. And so the question I have is, how do you deal with those kinds of situations where you're just asleep and all of a sudden you need to move your shorts further out or do something like that? How do you deal with that?
Rick?
That excuse me, that rarely occurs. I think it's occurred twice in the last 10 years. In most cases, if it moves up during after our trading, Asia, China, Germany, and London wise, our market makers have a tendency to bring it back almost half of whatever direction it has, if not more, the next day. So you've got an opportunity to get in or get out. Maybe not quite where the cheapest that you wanted to get out of, but you'll have an opportunity to get out or make money at it.
Mm-hmm.
Can you turn off the green iron condor and just leave the red iron condor on, so we could look at the curves there?
So yeah, Rick, you are in the same time zone, right?
Yeah.
So just it occurred just a couple of times.
Yeah.
That you can remember, actually, right?
Correct. And primarily when that did occur, the biggest worry problem was when it did occur at that time period and it continued the next day, it was basically in what I call a waterfall. And your best thing at that point is you get out of it. You take the loss and get out of it, because there's no way you're going to win.
Mm-hmm.
Okay,
but
so I'd like to say to answer that question. First, he's far enough out of the money so that overnight it probably won't, in today's market, it won't go up or down more than $4 or $5. So he's not completely underwater to start with. And then, like you said, if you wake up and you're already at a point where you need to get out, just get out and take that month's loss. Mm-hmm. And the third part is don't be 100% invested. In other words, if you only had a percentage of your account or investable money to this one trade, and you said it was only 10% or 20% of what you could put in, well, then you take the loss on that, but the next one you invest in is going to have such high volatility that you're going to make a killing, so that you lose a small one, and the next one you get in is going to have really wide wings for really high premiums, and you're going to make the money back the next month. So three different pieces on it. But I agree with you. I am very nervous about what happens if oil goes to 100 tomorrow morning. Never done that, never will do that. But I'm worried about that because I worry all the time. So you're not the only person that worries.
Yeah, well, I'm coming from this SPX trading background and still do that. And that in that market, this is my sort of constant worry, hedging on the downside all the time. And most of the strategies that you see out there, people don't even pay any attention to the risk graph, what happens to the left of the price graph, right? Or in this case, we also have to think about the upside. But
right. The small skew to the upside, and sometimes there's no skew at all. Sometimes there is a skew to the downside. So the oil market is around, but it's a little flatter. So a lot of the strategies that work in SPX don't work here because they're based on a downside skew. The skew doesn't happen as much here, so you can't really do the broken wing butterfly on the upside and have the same effect on it. But when they talk about an iron condor, doesn't really work in the SPX because the upside keeps getting hit and you don't get any premium for it. So why even have it? And here you get the same premium, similar premiums on both sides. So iron condors really can work in this kind of flatter skew. But yes, you can use the same kind of techniques. And since it's not skewed so badly, you could go out and buy some teenies, some 75 or 80 calls and say, well, if it went up there, what happens if it went up there? Or you could do ratio spreads. You could buy two and sell one and have something happen just in case the market doubled overnight. But if you spend money on it, remember, you're throwing your money away because it doesn't ever happen. But
well, I understand the logic of it, but I mean, you have home insurance, right? I mean, maybe you won't ever need it, but you still have to have it, I guess.
Well,
you don't know what you don't know, right?
Yeah, but remember, if you're naked, then you're completely exposed. But if you have an iron condor, you have a limited loss. You had $10,000 to invest. If you only risked $1,000 on this, and the market went up $10 tomorrow, you would only lose $500. And you'd say, well, let me take my $500 loss, and next month I'll make $200. But since the wings are so wide and the premium's so high, I can actually make $400 next month and recoup my loss, or that kind of thing. In other words, with the same risk next month, you'd be able to make more money.
Understandable logic, but then if you have some hedging technique or incorporate some hedge it from the beginning, now you can allocate more money to the strategy.
Exactly.
If you don't have any hedging, then you are starting to think, how much should I invest? 10%.
Exactly. Right.
And then it doesn't make, I mean, it makes money overall, but not as much as you would like.
Right. So if you started with a short straddle or a short strangle, you've got unlimited risk, so you can only invest so much. If you do an iron condor, you have a limited risk, so you can invest a little more. And if you're further away, or if you've got those dog ears that we're talking about, or if you've got some flyers, some little teenies on the outside, you can invest more. And I'm working on those same kind of strategies. How can I get to the point where even if oil went to 100, I would only lose 1 month's worth of premium. So therefore, if I lose 1 month's premium a year, or let's say I have the basic strategy says if you get to 200%, if the items you sold get to 200% of your premium, you just sell and get out, close out that month. So you actually lost this month's premium and you lost last month's premium. And if that happens to you twice a year, which it hasn't, but let's say it happens to you twice a year, you would still return 8 months out of 12 premiums. In other words, you would have lost you would have lost the 2 months that you lost, and you would have lost an additional 2 months worth of premiums, and the other 10 months would have netted out those two plus added an additional 8. So generally in your favor, but you can't put 100% of your premium you can't put 100% of your account into it because you won't be there next month to take advantage of recouping your losses.
Yeah, it changes the subject a little bit. I have never seen oil do like the Swiss market did one day, where they changed their base currency, I guess, from their currency to euros and
Swiss francs.
Yeah, and where they did over $250,000 change in less than 5 minutes. That has never happened in oil.
Well, all it takes is some unpredictable event just once, and that's it. And of course, whether it will happen, will ever happen, we never. I mean, we have no idea.
Yeah.
But let's say all this oil region gets some kind of scare, or something happens to the infrastructure, or something like that, where it shoots up by like $20, $50, $40.
And that's how much would you lose in that case? If you let's say you had $5 wide wings, and you were hoping to bring $1 of premium, you would lose at $4, right? And is that going to happen every month, or does it just happen once? Right?
So the goal would be to limit the loss, right? Probably to less than 100% risk on a given side, right?
But you were saying if oil went to 100 overnight, you would end up with 100% of the structured loss. In other words, if you had a $5 wing, you lose $5.
You're going to lose half. Well, you could lose more than half.
Mhm.
So if you brought in $1, you would lose a total of $4.
But you got a dollar on the other side.
And you would give up this month's premium plus lose $4. So then next month you bring in another $1, and next month you bring in another $1, and next month you bring in another $1, and by the 4 months out you would have been netted to zero. Now, since oil has never done that once, to do that twice in a year would be a miracle.
Mhm.
You'd still break even if oil moved more than $20 in one night twice in a year when it's never done it once.
Mhm.
It'd be a kind of statistical anomaly.
That's true, but it's just also what you have to consider is the psychological effect. If that happens even once, I mean, will you continue with the strategy even if the logic says you
Right.
should?
You got to look at it the other way. The psychology, what happens when it happens once? Oil volatility is fairly low right now. It's in the 28 or 25, and it would shoot up to 50. And so instead of collecting $1 for a $5 spread, you'd collect $2. So from now on, anytime there's a hurricane and an insurance company has to pay out, they end up making a profit because they can raise their rates, they can raise their premiums. And that's what happens here. We're an insurance company. We have to pay out one time. Now everybody's going to pay a lot more for their options, and we're selling them options. And so we're raising our premiums, and we get to recoup our losses faster. Now, remember, we're talking about something that's never happened, but if it did, you could recoup. And if it happened twice in a year, statistically, you should be able to recoup your money plus make a 10% profit over a 12-month period. But since it never happened, we don't know how. Anyway, that's why we buy insurance. That's why insurance companies have reinsurance companies. That's the same as us buying those way out of the money legs just to limit our losses in case the unthinkable happens. And that's why we also look at other strategies, because the market is more likely to move $3 or $4 over, well, it's more likely to move $5 or $6 over a couple of days, like right after the oil report, it went down $2.50, and I've seen it move $4 regularly after those kind of news events. So those kind of moves are more regular, and you can adjust for those. And then if it moves $4 3 days in a row, well, that does give you a chance to get out with a 50% loss instead of 100% loss. And then there's also other strategies we're looking at to try to hedge the unthinkable. And those kind of things, you're throwing your money away because you're saying, I want to have insurance against a meteor hitting me. Well, a meteor could hit you any day, anytime, in any building that you're in, it could hit, but it hasn't, and it probably won't. So do you want to throw away all that insurance money, or would you rather be the insurance company collecting all that premium for something that'll never happen?
Well, it's a personal choice, right? I guess.
Yeah. It makes me nervous too, because I'm the engineer type and I want to win on every trade and I never want to have a loss. But
me is the same way. But then, I mean, I'm an engineer, and but
so think of that as our problem in our mentality is we're not gamblers, we're engineers, and we want I look at my theta and I want that theta to appear in my account every single day. It doesn't happen that way, but I want it to, and it bugs me when it doesn't. Where more likely I lose, then it all comes back. I lose, then it all comes back. Well, the same kind of deal here. You make money, you lose one. You make money, you make money, you lose one. If you do that, if you think of it that way, you should be able to have 2 losing months and 10 winning months and end up with 8 months of net profit. And if you think of it that way, then you're a gambler and you're taking the odds, and you know that sometimes it's going to end up red and sometimes it's going to end up black and sometimes it's going to end up green and the house gets the money.
Yeah. Well, the only question, and we saw the chart that Rick showed, right? And that it was pretty consistent. The chart was showing constant, well, not constant, but gains, and then you have this spike down, right? Which is a trade that took a very sizable loss, basically, right? So the only question is that we have to think about how to limit the size of that inevitable loss when it comes, right? So we want to limit it to maybe 2x. or 3x of your typical gain.
Yeah.
As
Yeah, I would
opposed to
start-
10x, because that can be really damaging from the psychology perspective, right? I mean, you worked the entire year, and then one event wipes 10 months of your work. And then, I mean, how likely are you to continue with the strategy after that? So that is
Exactly.
the question for me.
Well,
Then you look, got just interrupt there. If you do that, then you want to look back and see where you could have reduced your loss potential. And review.
You mean how, right?
Yeah.
How you could
What-
have
what-
handled the trade.
Yeah, how you handled
Better.
it, where you could have, where you need to make improvement to limit your loss.
That's true.
Uh,
But then I mean, if you are paranoid, like maybe I am, you also have to think about putting the structure in place from the start that has some protection for these cataclysmic moves.
Yeah, and then there again too, you always start small.
Yeah.
And if you have a big loss, you start small again and work up.
Mm-hmm. But going back to your personal routine, I mean, do you even wake up during the night, or how often do you check your quotes during when the oil is open? Do you look at it at night, before you go to bed, when you wake up? What do you do, or you just don't care?
One of my, I guess, mentors, his suggestion was to always look at 15 minutes before the open and 15 minutes after the open and 15 minutes before the close.
Mm-hmm.
And basically at that time, that's when you make your adjustments.
And
In between there, you kind of just let it run, because multiple times I have seen, and I've even exited, not using that strategy, to see at a loss, and then by the end of the day, had I done nothing, I'd be ahead.
And tell them what time oil closes for you.
Say again?
Aren't you on the West Coast? Tell them what time oil closes on the West Coast.
He's on the West Coast, so he knows what time oil closes. Oil closes.
I don't really. It's
2:30. 2:30 Eastern time. 11:30 our time.
11:30. That's the close of the oil pits, right? Or
electronic that's when they lock in the closing price of it. It continues. They continue trading it until 4:30,
but if it continues trading, that means you can still adjust position to position, right?
Yeah, you can adjust even after hours wise. If you have an open trade that you want to either get in or get out of, you can put your GTC there and it can be filled. I've had them filled after hours.
Mm-hmm. Yeah, and remember, you've got volume problems anytime during the open and close like he's talking about. Now, the opposite of what he said, I'm up all night and I made a trade at 5 o'clock in the morning before the oil report, and 5 o'clock Central Time. And so I'm up at 2 and 3 and 5 o'clock in the morning making trades, and every one of those was wrong. In other words, if I had not been there, I would have made a lot more money.
Mm-hmm. So why don't you stick to the same guideline? Huh?
Yeah, because I'm paranoid like you are. I'm always worried about every penny and every trade. So I overtrade, and it ends up biting me.
But yeah, well, but I remember you mentioning you are trading strangles, right?
Right.
Which I assume far out of the money and higher DTE, right? Maybe like 90, 100.
That's right.
And so even in that case, you have to sort of nickel and dime, right?
No, I shouldn't, but I do. And like I said, right before the report, I was worried about my negative delta. So I went and bought some deltas. And all that money became worthless. So if I'd have just slept through it, I would have made $1,000 more than I did.
So, but I guess what I'm trying to understand, if those positions are that much out of the money, I mean, do they? Hello?
Okay.
Sorry about that.
Something happened. So yeah, if you are trading that, I mean, by $20 out of the current price, right? Can you guys still hear me?
Yes.
Yes.
Okay, so even if that in that case, if oil moves by $4 or $5, you find it necessary to sort of adjust your position.
Well, necessary and having the urge to do it's two different things.
I see. Okay.
So basically, I overtrade because I jump in there and want to do a little bit nibble instead of waiting till the last second and taking a big loss. It's like, oh, like if I had 20 contracts somewhere, I might say, oh, I need to put a one credit spread or one debit spread in there to offset my deltas or something like that. Nibble here, nibble there, and do lots of fidgeting around, which I would have been better off if I hadn't. But on the other hand, I have some other positions that are long puts that are in the money now. So I made money on the other side, but I don't think it still doesn't take away from the point that I bought some insurance that I didn't need by messing with it too much. But you've touched several of the positions. One is to buy some insurance to start with. Well, that's what a non-condor is. It's limiting your losses so that you don't have a $40 loss. If you had a 5-point wing, the most you could lose is 5 points. Limiting your investment in any one trade or any one position so that 100% loss, that would only be a 10 or 20% loss on your whole account. And adjusting sticking to the basic rules of 200% or 300%, whatever you have as your adjustment point. And so that's already mentioned all those different points of different ways of handling it.
Okay. So the oil closes at 11:30 Pacific time, which means the oil pits, right?
Yeah.
The oil pits. Now electronic session
no.
will continue until about 4 p.m., right?
I don't think there's pits anymore for oil. It's all electronic.
It's all electronic, but there is still this knowledge of some closing time.
Yeah.
Even though it continues trading. Right?
Take a look at the volume. Take a look at the volume on your chart, and you'll see when the markets actually trade. In the last minute, there's a huge amount of trades, and then nothing the next minute. And that'll tell you.
Oh, okay.
When you have close bid and ask, and when you can actually get something executed, you can usually buy a single call or put, but trying to get a spread or a four-legged spread in those low volume markets are pretty tough.
Mm-hmm. And what about when does it open? When is the official opening time in Pacific?
8 o'clock.
On Pacific, 8 o'clock, 8 a.m.
Eastern, basically 5 a.m. West Coast.
5 a.m. Okay. Okay. I see. And sometimes as I'm looking, let's say on August 8th, right? So the move started at about around 3 a.m. Pacific, which is where the pits open, right?
Yeah. Oh, I can tell you. Remember that little? If you look minute by minute, that little bump up. That's where I bought the insurance bought some calls, and from that point on, that's when it went down, and that's where I started. I bought the calls on the high of the day, and it went down all day long.
Yeah.
So it might not be so good to be trading overnight. Maybe those guys are manipulating the market a little more than they can during the day.
So but based on your observations, then, most of the movement takes place when the market is officially, so to speak, open, which is from 8 a.m. Eastern until 2:30 p.m. Eastern, right?
I think that's when the big players are there. If the bomb goes off over.
Yeah, 3 a.m. is when Germany opens, which is Eastern time. And then from that, then London opens at the same time, and then those guys they close at 11:30.
Okay.
And Singapore closes at 4 a.m.
Okay. Now, just one more question would be that we discussed sort of at some point, there was discussion about backtesting. So, I mean, the only software it looks like that is capable of doing some good job in that regard is OptionView, right? Currently, it looks like. I mean, I know OptionNet, they started supporting CL and other futures, but it looks very raw. How it feels and how it works to me, and I'm not even sure that the data is all that good, or I'm not entirely correct. What's your experience in this case? I mean, I would ideally like to throw some trades on and just to go walk through them, at least several, to put a decent plan in place for oil.
Say when I first did it, all I did was basically take the CL's charts, backed it up 5 years, and looked at a date and put on in that particular time a strangle, and moved it forward a day, and I was looking at. It started 28 days before expiration when I first started that. And then I moved it forward a day at a time to see if there's any adjustments that I needed to make. And then at the end of that time period, at expiration wise, I looked at it and said, okay, did I make money, or was it under the tent or outside the tent?
So basically you only paid attention to whether it touched one of the shorts on either side, right?
Right. And
but,
at that particular time, I noticed that it would touch the short side that I had, but then it would go back, head back towards the other side, and it may touch it or may not touch it again.
But then how did you judge your profit and loss, whether, let's say, it got close to as close as $1 off of the short strike? I mean, did you have any way to judge your P&L?
I had basically, there's no P&L because I had my endpoints, my long and my two shorts. As long as it stayed under that tent, I was going to get 100% of what I brought in.
Yeah.
So it didn't make any difference whether it was a $1 or $100,000. As long as I could keep it under that tent, that's what I was going to get. So that's kind of my strategy today, is try to keep the current price under the tent that I have built.
Yeah, but in your current strategy today, do you pay any attention to the level of profit loss, let's say, that you have currently to make any movements on the trade? Is there any particular loss level where you're just bailing out?
Basically, I'm looking at, after having to make 2 rollout adjustments, the third one is the final one.
And no matter what the current P&L is?
Right.
Okay.
So if it gets to, I try to break my quantity up into thirds. So if I've got, say 4 or 5 contracts wise, I'll do one. I'll roll one at 1.5, another one at 175, and the last one when it's double what I brought in for income. So my starting range on income is at least $1 per short. So when it hits $1.50 from my $1, I'm paying $1.50 to get out of it. I roll that one up by a ratio of buy that one, and I'll sell 2 others further out for a profit.
Rick,
yes.
Richard, sorry to interrupt you. Since now we have a forum set up for us, would you mind writing that down in the forum, what you just told us?
Yeah, as soon as I get some time, I'll try to get that. I'm on it.
Yeah, I think that is probably the most helpful point that 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 we all need. So it
Yeah.
would be good if you can write it down in the forum, so we all will have access to it.
Okay,
Yeah.
so this is Richard, if you can hear me. I actually did begin that in the forum. There is, I think, maybe the very first thread. I attempted to start something with the best I could remember, but it needs to be fine-tuned somehow. So I think some of the basics are in there, and I agree that that's the best thing is if we can get some of this stuff down, because we can hear it, but we forget it, and we can't remember all the points.
Yeah. No. Been there, done that. Had to do it.
I think that's the point. Is the people who are talking or asking about it, I think you ought to write it down and put it out there and let us correct it, so that if you'll ask us to make a couple of corrections rather than putting out all the text on our own. So
Well, and that's what I did. And for that reason, I put it out there, so it's kind of sitting there.
Yeah, I don't like people saying, "Hey, can you dump all your information and work 24 hours a day and write all this stuff for us so we can learn how to trade?" It's like, why don't you listen to what we have, put it down there, and say, "No, it was 200%, not 300%," and we can correct it line by line. And remember,
It's a point well made. I'll take a look at it and compare it with my notes. And
right?
Maybe
Because
we
if
can
you
talk about it next time.
Excellent. If you understand, if you write it down, you'll have a better understanding, and you'll be trading your plan, not someone else's, because someone else may have a different caveat on it.
Sure.
That's another thing that I found. You have to develop your own plan. You can't take somebody else's plan and you do it, because no matter how you do it, you're going to develop it into your own plan, because you don't have the same financial finances available. You don't have the confidence level as somebody else, and there's a whole psychological profile that goes into that too, that you have to develop over time.
Well said, Rick. I think you're exactly.
I personally, I know where everybody's at, because that's what I wanted. Somebody to tell me, give me a plan that I can trade and I can sit in here and start making money. I didn't want to wait 10 years to learn how to do it. Well,
and how long did it actually take you to get to this point?
I'm still learning in 11 years.
Mm-hmm. As it applies to the oil market.
The oil market, I started in 11.
Oh, that's not bad.
As I say, my oil market started because, oil, it was, I think it was running about $100 a barrel at the time. Gas at the pump went up to $4.50 a gallon. And when oil hit $142 a barrel, it only got up to $3.42. So I figured, screw it, I'm going to learn something. I'll trade this. And my goal initially was to make $500 a month to pay for the gas bill.
Mm-hmm.
Well, at $500 that first month turned into $5,000. So needless to say, I got greedy. I said 5,000 is better than 500. So I continued on, and for the next 4 months brought in that amount of money. On the 5th month, I got an education.
Mm-hmm.
I did my usual. It was oil's at 100. I was using two standard deviation move for my short, so I put on a short at 85 on the put side. I got 68 cents for it. Within 2 days, oil dropped $3, and that 68 cents went to $1.36. So I did not, I didn't really have any adjustment plan at that time, other than when it hit the short strike wise, down to 85. And at that point, it did go down to 85. So I ended up looking at it and I said, well, I better take my loss and we'll go from, otherwise I'm going to get killed. As it turned out, oil it dropped down to 77. And then by expiration date, it expired at 87. So if I'd have been willing to risk $80,000 and have my wife come after me with an axe and it stayed at 77 instead of getting back up to 87, I would have, I would have made money instead of losing what I lost. But I lost, pretty much what the first 4 months of income was.
Mm-hmm.
And then from that point on I think I went basically about 24 months straight without a loser.
Wow.
But then you already started adjusting trades, right?
That, after a point, then I got with another. I was in with Dan Sheridan and his group, and there's another gentleman there that I asked him what he was using to adjust for his trades, and that's what his deal was. He would roll a third, and a third of whatever was in trouble out of the way and move it down or up depending on direction. And that's how I started that one. And so I've taken that one on, and then over the period of time, instead of 28 days, I found it, well, if I started it at 35 days, I can be in it for 14 days and I'll get to keep 80% of what I initially brought in, but what I initially brought in was double what I would have brought in at 25 days. So I figured, well, I can be out of the market in 14 days. That left me with that much more free time. So I just said, that sounds good. Don't be greedy. Another one is saying that was going around in the day was, if you're trading naked, you don't trade naked, but don't be it's all right to be a pig, but it's not correct to be a hog because hogs get led to slaughter. And so I've tried to remember that one there because that's it's very easy. I had been slaughtered quite a few times in the past by especially trying to go to expiration on these things. So I can get there. I can keep 80% of what I initially bring in, and get out in 14 to 22 days. Is better than sitting in 28 days, starting at 28 days to expiration and riding it through expiration and just getting to keep what you initially brought in. But so that's everybody's.
So it looks
philosophy
like
there.
It looks like you learned about that rollout strategy and pretty much stuck with it up until now, right? As far as moving the short further out and doubling.
I still do that to this day.
Okay.
When it's needed.
Mm-hmm.
If it, and I have to sit and wait. It not at 45, not at 46, not at 49, but you sit there and wait till it gets at least 50. And I'm finding that it might be a good idea to sit there instead of maybe doing it at the first 50, but when it comes back down again, wait until the second 50 to roll. But that's everybody's personal preference. But I usually do it on the first time it hits 50% more than when I collected to roll it out.
Mm-hmm.
And that is, in certain cases, it can prove to be an advantage, because I've had one case where it hit to 50%. So let's see, I hit the 50%, or so I rolled it, and then price decided 2 days later to drop down below to where it was. So I was able to make enough money on the roll that I collected more than what I lost, plus the profit that I was looking for on the trade. So I was able to close it out. And the original option that I had was still above what I initially brought in on it. Does that make sense?
Mm-hmm.
So I was able to get out with make up for my losses, had the profit that I was looking for on it, and I was clean of the trade for a profit. Where if I'd hadn't made the adjustment when I did, I'd still be negative. It would still be negative, waiting to try to make my initial, my target profit.
Yeah. So the market just basically ended up reversing. So you increased your, it looks like, negative deltas and brought more into the tent, and then it just reversed and went down.
Right. In this case.
Yeah.
So I actually more positive deltas on that one, but so.
Okay, on the other side. Okay, got it. Thank you.
So that's, that's it. Everybody needs something, then you can make your variations on that if you want. But say if you do a third at 1.5, a third at 175, and then the final third at 2, that gives everybody an opportunity to make some form of adjustment.
Mm-hmm.
I think Mark does some rolls where he'll lose money. He'll pay to do the roll up. I always try to make an additional 200, 3 cents to 10 cents, or if I can get 20, which is really hard to do unless IV is way up on a roll per contract wise, and I'll go for it that way. I try to get as much as I can on that roll, but I'm rolling usually 1.5 to 2 strikes. 1.5 to 2 strikes further from where the initial strike was. So if it's 70, I'll go to. If it's 78, I'll go to 80.
Mm-hmm. Or 79.
Or 79.5.
Right. Now I wanted to comment on that too. I might roll out to 70.5 and take a loss, but I also may roll my puts up to 65 from 63 or something like that to kind of break even. But I'm not trying to make extra money on it.
Mm-hmm. Okay.
All right.
I have a question on a slightly different topic. Does anyone in the group have experience trading the USO options as opposed to futures options?
Other than it takes you 2.68 more, I guess you can say, shares to equal one future contract in income.
Yeah. Now that may not be a problem if they're only charging $5 a trade or $10 a trade, no matter how many shares you buy. But I think the problem I hate with the USO is the K-1 filings you have to do with the IRS. So whenever they make money, they'll assign you amount of earnings, and so you'll have to pay taxes on something even if you made a loss on it.
The other advantage of this is USO is also a standard option. So in most cases, if you buy one contract, you still pay $10. If you buy 10, you still pay $10. So it's $10 for the contracts. Where do
you get
futures,
that deal?
Thinkorswim's got that.
Oh, okay, because
Tasty Trades, I'm thinking is better than that, but
Well, I hadn't heard that from Thinkorswim, but I heard that on the Tasty Trade commercials. But that's pretty good if you're doing 100 contracts. If you're doing, say, 100 iron condors on USO and you only had to pay $40 total commission, then that's a pretty good deal.
350 times 100. Yeah. Okay.
Times 4 legs. Yeah, that's a lot of contracts. That's 400 contracts.
Yeah. No. It's let's put it this way. In its day, it was good. Yeah. Because TD Ameritrade was in 05, I believe, 03, 05. It was 19 and a quarter plus 250 a contract.
Yeah.
It made it very difficult to make any money other than the brokerage house.
Yeah. I'm looking at doing similar type deals because you can have a finer grain on it. You can buy you can buy a smaller dollar amount of contracts on the USO than you can. So it's a finer tooth comb to be able to deal with that. My problem is I just don't want to have to deal with the K1 at the end of the year.
Yeah, I say then the futures also has you have to fill out the 1260, but it's 60. I think it's 60% capital gains, 40% short-term gains.
And it's all one line. They roll it all into one line and say what's your plus or minus for the whole year.
Yeah.
Another reason I'm asking that question is that TD Ameritrade in IRA and Roth IRA accounts doesn't allow you to trade options on futures.
Yeah, right now that's a good point. Some of the competitors do, but they don't. And in that case, the USO would work out pretty well, and especially if you were in an IRA, you wouldn't have to worry about the K1 because it just becomes earnings.
That's
and
right.
You didn't put it off until you're really old, or you may never make it to that point.
Right.
Let your kids worry about it.
Okay, thank you.
All right, so I'll try to review. Make some time. Remember to make some time here to look at the forum. I am on the forum right now, but
I'd like to get everybody to look at that forum. I wrote a piece out there structuring the 4 different basic parts of commodities trading that we all need to realize, and I'd like to get everyone that's listening to us to come up with something that they care about. So if they're worried about a technical analysis, they're worried about Fibonacci's or Elliott wave theory, or support and resistance, or if they know something about commitment of traders, or if they know something about seasonality, or if they know some news, if they happen to have a news pipeline into what Saudi Arabia or Russia is going to do next week, I'd like them to bring that to the table too.
So along that line, Mark, you suggested that and this is Richard, might be able to show something on volatility, and I can show you just something here real quick if you like.
Yeah, that's one of the things I've forgotten to mention is that each of you got to worry about the volatility, and most of our projects work better in higher volatility, and we have problems in lower volatility. Go ahead and get the screens changed while I talk through this.
Screens changed what?
Let Richard have the screen.
Oh, okay.
Yeah, in a lot of our cases, what happens is the market will become less and less volatile. It'll trick us into getting these tighter and tighter iron condors for less and less money, and then it'll pop $5 or $6 and take all our money away from us. So you got to be a little leery about going for the cheese and not looking for the trap. So when you get closer and closer and lower volatility, they'll spring the trap on you and move the market $10 and run through all your shorts. But when the volatility gets high, it's a great time. That's when you're scared, and that's when you shouldn't be scared. You should be real greedy when the volatility is real high and take all the money there, because then the volatility will crush along with the theta and help you. Have you got it yet?
Can you see my screen?
Here it is.
Should be just one screen. Okay.
Yep.
Okay, just real quick, what I have up here, oops, I got the wrong contract on. Let's get what we're talking about.
You got to close the banner to the left.
Yeah, it doesn't really show anything, but okay.
Yeah, we don't need to see that. There we go.
Okay, so what I have here is just a daily on the September contract crude oil, and minimize this a little bit down here. So the bars obviously is the crude, and this is the let's see, daily. This looks a little bit like, excuse me 1 second here. Extended areas. Okay. All right. So this line right here, all right, that is your OIS. This is your comparison, all right, and you would read that off to the left here, and this is the percentage.
OIS?
OIS, okay. Now also
OIV. Now haven't heard of OIS.
Okay, okay. So the OIS is the volatility on the options, and I'll show you. I have OIV also, and that should be down here somewhere if I can find it there. This is OIV along here, all right? Again, relating to this left scale. So you can see how the OIS goes up, the implied volatility from the options goes up considerably here, whereas your OIV makes less gyrations. All right, so that's down here. Now, let me just bring this back to what we had. The next thing I would point out is it's kind of interesting to see how your OIV goes up and down at different times. Notice how it's kind of tracking up as your futures contract goes up, down as it comes down sometimes, all right? Now what we just had, and as it went up here, it did not go up. It kind of tracked sideways, 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 up. And then when we had this big drop down yesterday, it went down from about, let's see what we had here.
Yeah, I was real surprised on all those big moves. The volatility really isn't increasing.
It actually did yesterday. This does not showing it too much.
Okay.
Go to an hourly chart here. And
is there a symbol to put in before OIV or OIS?
I'm sorry?
Is there any other symbol? Because OIS is a company name, so is there like slash or $sign or anything like that?
No, you can, in fact, you can do OIS. You can, I'll type it right in here.
Okay.
There's your OIS right there. And again, read this off to the left.
That sounds like Oil States International. It looks like a company name.
That's a default one.
Yeah, I think that's a company. Anyway, let's try OIV. That's a volatility. That says volatility. Yeah, that says volatility index. I'm not sure about the OIS.
Yeah, that's what I've worked with and how it was explained to me many times. But you can see from my previous display that the OIS does go up and down with the market.
Yeah, it does. I'm worried that maybe there's another symbol in front of it, like a dot or a slash or a $sign or something else.
Well, let's put it there. Thinkorswim does put out the implied volatility options. You can see it under trading, and you can see it. You can see it on the price sheet too. But
Yeah.
I don't know. I don't know if they graph it.
No, they just put what it is on the bottom of the analyze page, but it's just the current number. They don't show where it came from.
Excuse me. And like I've got currently rise. I got an implied volatility on the option of 24.31.
Mm-hmm. And when I was selling some of these weeks ago, it was 30 or 29 or something like that.
Let's see here on the 1st of August wise, when I bought it, it was 26.24.
Mm-hmm. I think a lot of my positions have really benefited from the slide in volatility, which is great, but that means I have nothing to sell now because the volatility is so low that I can't get anything for it. One of the things that Chris did was he would sell on Wednesdays right after the announcement. So Wednesday noon, Wednesday afternoon, but a couple hours after the announcement when volatility was still high but sliding quickly. So that's kind of a day trading deal. It's like, what day would you like to put your positions on? Well, Wednesday afternoon.
Okay, so here you can see, this is a daily chart going back to March, how we were down here at 25, all the way up here to about 37, etc. Now this is just the OIS. This does not have any oil on it, but you can just see how the OIS moved. And also interesting is if you go to a hang on here. Let's go to a weekly chart. You can see how it has fluctuated week by week, which I think is pretty easy or pretty interesting to look at there.
What's the green thing that's popping in and out?
This is a moving average right here.
That's one below it. The one that keeps going off the bottom of the screen.
Okay, so that would be your OIV.
Okay.
Yeah, that's your comparison line, OIV. Okay.
Okay, I'm not buying that OIS. I think OIS is a company and it has the chairman and has earnings and stuff like that. So that's Oil States International. And I think you need to use OIV or OVX because OVX is the volatility of the underlying and you're looking at the implied volatility of the options or probably OIV. But I'm not buying that OIS is not a company because I'm looking at the earnings reports and this chairman statements and stuff like that.
So you're saying OVX?
No, OVX is the volatility of the underlying. So that's the historical volatility.
Okay.
And then the OIV that you came up with is the volatility of the options. That's implied volatility.
Oh, the OIV. Okay. Okay. All right. So OI is the
Go ahead and type it in. Go ahead and type in OIV.
No, you know what?
This is volatility index.
Yeah.
But I had never heard of that until last week, so I just think that's what it is.
Yeah, I got those two mixed up, OIV. But so now let me let's go back /CL and let's change this to OIV. Okay, here we are.
Yeah, OVX and OIV track each other pretty well,
Yeah,
but
yeah.
the OIV worries about things to come.
Yeah, no, good catch. And I've messed that up before. Okay, so here you can see some bigger excursions back here.
Yeah, that's where we want to sell, is when it's way up there.
Yeah, the only trouble is you usually can't because that's oil report day and that's during the oil report when they put a $6 spread between the two, put bid and ask.
Yeah, and you can't do a four-legged trade during those periods. They'll just ignore you.
So anyway, bottom line is it's kind of interesting to watch and time your trades as much as you can. Let's go back to daily here.
I think it also has to do with fear too. If you're worried about your deltas or you're worried about your losing money, you can't figure out why you're losing money, you look at the volatility went up, just realize it's going to come back down. So it'll keep you from over trading if you realize, oh no, I'm losing money. Well, that's because the volatility is going up, but in a couple hours it'll come back down and I'll be okay.
Well, yes and no. I played that game back when the oil went from, what, 100 down to 40 or something like that. And it just kept going up and up and up.
Yep. Yeah, I'm worried about those kind of movements. It looks like we're on a steady march to 100 again, but I don't know if it's not going to take us a couple of years to get there.
Let's see what we got here one more time. Okay, so here's the OIS now. OIV, I'm sorry, OIV. And you can see yesterday we had this big drop. And it did shoot up right there.
Yeah, but you wouldn't call that shooting up. I mean,
no, it's not as big as what I would have thought, for sure.
Yeah, that's amazing. I think there's one day, but 2 days before the option expiration, that it shot up. The volatility went up when the market went down, but just about every other time, it's like they don't really care.
Now look back here. February, shot down. Volatility shot up here. Then it came down as soon as the oil started going back up.
But on a lot of these cases, the volatility is going up when oil goes up.
That's correct.
I don't know that we can make a heads or tails of it. I think we just need to watch.
And here it's steady and volatility goes down. Oil drops down and it shoots back up.
Mm-hmm. I'm glad to see it. Glad to see it as a two-way market, though. And it's not just one way like the stock market is.
Right. Trying to look for when it goes up. Most of these times it's shooting up when oil is going down. Here you have both the OIV and the underlying tracking each other pretty close.
I think this is one of the most important, or one of the three important legs of the stool. You got theta and delta and the volatility. Now, delta is probably the most important, and theta is probably just real standard. So this is the only thing we don't know much about. We need to know more about this part.
Right. So anyway, that's all I had to throw out at you guys. It's not bad to just kind of graph this, have a comparison line, and instead either the underline or OIV, and just kind of watch it.
Yeah, I'd like you to bring that back each week. We're going to try to do it in between meetings, but I think you ought to bring that point up each week.
Yeah.
We talk so much about delta, we forget to talk about volatility, and say, how come we can't get 10 points away from the market? Well, because volatility is too low.
Yeah, I would like to. When was it that we had that big oil spike? Let me go to the weekly.
2008 at 149.
Okay, that's one more time. Let's see if we can find that.
10 years.
Yeah, it's got to be at least 10 years. Might have to customize. Yeah, you've only got you're gonna have to have multiple years. So you've only got 10 years on that. You're gonna add.
Oh, your 10-year weekly.
There it is. Yeah, right there.
Scroll down. Scroll down.
Ah, there it is. Yeah. Good. All right, now let's go back.
Yeah, all the way to the right, all the way to the left. Did you get it in there?
Okay,
Still
what
don't
was
know.
the year?
2008.
2008, and this is 10.
Yeah, I think that's 9 and 10.
Was it 08? Was it that long ago?
Yeah, after the stock market crashed, everybody put their money in oil.
No, Enron. all the Enron futures traders jumped into oil.
Yeah, there was a whole market movement that says, well, we got to diversify away from the stock market, and the stock market's so much bigger than the oil market or the commodities market. They put them in commodities, and they just shot them. They went on the long side, and I think we went from 3 speculators to 1 delivery to up to 9 speculators for every in every person that cares about oil.
Okay, so here we're at it's a date. Okay, that's 99 there. All right.
What year?
Hey, that's probably it right there.
This is 08.
Yep, there it is. 147.27.
Wow.
That's way up there.
See if I can find the.
Oh, put your cursor on the 146. Oh, that's it. The indicator doesn't go back that far.
No. So this is 10. Okay. 2010.
That's too bad.
Down, 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 down.
Well, let's go back to when you lost your money, when it went from 100 to 20, 26 or whatever, 28, wherever it crashed in.
26 or 36, I forget which.
Yeah, look at how high it was there.
Okay, when did you say?
Those peaks in the purple line, that one and the one after it.
Okay, that's probably 15, February of 15.
And what's the price on oil at that point?
Price on oil is right around 48.
Okay. Let's go to the next one to the right. It even got higher. What's that peak?
Okay, so your volatility is all the way up to 80%, and your oil is about 26.
I bet you that was a Wednesday spike.
That's what it was. But it's just been coming down since.
Down, 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 down. Yeah.
Because I think a week or two ago, they had one that ran up to 47.
Yeah. I've been trying to work on strategies that say, well, in a low volatility market, maybe we should be buying some volatility instead of selling volatility. And so I haven't got anything to present yet, but that's the kind of stuff I'm working on, is to say, well, we ought to have our mix of long to short, whether we're long or short stuff, depending on how much the volatility is. And if volatility is real low, eventually it's going to come back up, and we ought to take advantage of it. And when it's real high, we ought to be selling everything we can. Well, like I said, that's one of the 3 legs of the stool. and we can't do much about theta. So it's delta and volatility are the two we got to worry about.
Okay, so right here, October of 16, 2 years ago, we had a pretty good spike. And oil was at $29.
Mm. There were some people telling us it was going to 10 at that point.
Okay, guys, that's all I got.
I appreciate it.
Sounds
Let's see
like
it
a good
again.
meeting. Save some for next week.
Yep, bring that chart back next week, and we'll add some technicals and some news items.
Yeah, okay, you bet.
Thanks, everyone.
See ya.
All righty.
Thank you.
Thank you. Bye.
Bye.
Yeah, bye. Thanks for coming.
Bye.